It's Barry here. I get asked all the time, what is the best way to maximize my Social Security benefits from our clients and prospects? And so I figured I'd just put an education module together so you could watch it at your own leisure about the basics of maximizing your Social Security benefits. And then if you have any questions or want an in-depth analysis, just let us know and we'll be happy to work with you. So, of course, we have a series of disclosures. You can read that on your own. A little bit about me right here. I've been in the business a little bit more than 15 years. I've got several licenses, securities licenses and insurance licenses. So what I want you to learn today are the 6 things that you can do to maximize your Social Security benefits, how complex the system actually is. It's a very, very complex system. And in general, about how much Social Security should influence and how much Social Security should be as part of your overall retirement plan. We'll also talk about the monetary consequences of benefits of claiming early. People ask about claiming early versus later. Spousal decisions. What are the right strategies for my spouse? What are the right strategies if you're divorced? And how Social Security is structured to combat inflation using the cost of living adjustments. So, the 6 fundamental planning considerations for financial planning in general. Longevity. We're living longer. We're living longer than our parents have. Typically, in the past, people had things from their employers like pensions that guaranteed income for life or guaranteed income for 2 lives. We don't have a lot of those around right now, so Social Security is becoming more and more important for people our age and our immediate parents, a parent's age. And many of our parents do have pensions, many of us don't. Liquidity. In the 6 fundamental things that you look when you're building a retirement plan, you have to have liquidity. Social Security is not a liquidity asset, it's an income asset. So you have to have liquidity in other places. Inflation. How does inflation compare today to cost of living adjustments? We'll talk about that. I don't believe the cost of living adjustments, the COLA adjustments in Social Security actually do keep up with inflation. What about the markets and unexpected volatility in the markets and how that can affect your overall plan? Mortality. Social Security is affected by mortality. We'll go through that. Mortality of the primary or of the spouse. And then taxes. How does Social Security affect your taxes? You'd be surprised at one of the calculations we'll go through later when it comes to municipal bond income. So let's start off by understanding the potential impact of maximizing your Social Security. Let's calculate the total average husband and wife's Social Security benefit. We'll start with the wife's calculation because the wife lives longer than the man, but the average Social Security benefit across the United States is $19.76 per member of the household. That's the average. It's not yours, it's the average. So if you multiply that by 12 months, the projected annual income for the wife is $23,712 a year. Average woman lives 22 years collecting Social Security. So the total benefit for a woman, the wife, is $521,664. If you do the same calculation for the men, who typically live 19 years in retirement, you add those 2 together, the total value over your lifetime of Social Security for a married couple is about $1 million, $972,192. Why is that important? Well, it's basically telling you it's $1 million asset, so you might as well maximize it. So the cost of making mistakes, a recent study highlighted that the average individual will lose $182,000 over the course of their life if they make a Social Security planning mistake. So let's avoid that. This brings us to why we're here. How do you maximize Social Security in retirement? Here are the facts. 68 million Americans receive Social Security. On average, the Social Security income represents about 30% of your income needs. So Social Security is important. So let's talk about it. What do you need income for? Shelter, food, clothing. So there's income that comes in for what you need versus what you want. I think that Social Security is in the need bucket. I need Social Security to cover my needs. Other things like what you want are travel, second home education, hobbies, memberships and such. Those are what we want. So Social Security is in the inner circle core need for just about everybody in this country. The problem is there are those 6 risks we talk about that affect the income for your wants. So let's maximize the income for our needs. Here are a list of other Social Security sources that people come up with, but at the end of the day, Social Security makes up about a third of most people's income. So why are we here? We want to protect that income and maximize that income for your needs versus growing your income for your wants. We want to maximize the income for your wants by protecting what income you have for your needs. So here's what we're going to talk about. The primary planning challenges, the important definitions, benefit calculation, and key changes in the Social Security Code, 5 common decision scenarios. I'm going to run through 5 different examples. Maybe those apply to you, maybe they help you, but if you need more specifics in your plan, let us know. We'd be happy to run those numbers for you. What is cost of living adjustment, and what are the taxation of the benefits? How do you handle a mistake? Many people make mistakes. How can you handle a mistake? And what are the strategies to maximize your benefits? So here are the planning challenges. When it comes to Social Security, a married couple has 9,000 different possible claiming combinations. The Social Security Administration will not help you with any income or investment asset outside of the Social Security calculation. So you got 9,000 different choices. You go to one provider, Social Security. The rest of your portfolio, they cannot help you with. So they're prohibited from giving you any advice outside of Social Security. So the rules change. They changed this year. They changed last year. So let's go through how to maximize it. Oh, Lawrence Kotaloff. Social Security is about as complicated a fiscal system as a human can possibly design. So you got 9,000 different combinations. It's super, super complicated. Let's try and simplify it a little bit. All right, so the first thing we got to do is understand what the definitions of the equation are. Primary insurance amount, the PIA, that's the payment that you get receiving at your standard normal retirement age. This is the benefit is neither increased by delaying or reduced by taking early. The PIA is the standard. Some people it's 67, some people it's 66. It just depends on when you were born. COLA, C-O-L-A, that's the cost of living adjustment. That's how much your Social Security benefit increases each year. It's based on a COLA equation, not an inflation equation. Everybody who's in Social Security this year understands that COLA went up, in this case 2.5%, but inflation and your real cost of living went up much more than that in 2025. So COLA, people think it's an inflation adjustment. It's a cost of living adjustment. It does not typically keep up with inflation. What is full retirement age, FRA? If you're born before 1937, it's 65. Between 43 and 54, it's 66. And after 1960, it's 67. How is your benefit calculated? They're based on your lifetime earnings to calculate your PIA, primary insurance amount benefit. They will index your earnings for inflation. The PIA benefit is based on the highest 35 of the indexed years. So let's say 20 years ago, you had a great earning year. That earning year is then adjusted for inflation, then goes into your calculation for the 35. That's what that means. I'll repeat that. 20 years ago, you had a great earning year. That earnings year that you reported is then adjusted for inflation, then it goes into your PIA calculation. And this is the amount, your PIA is what you get at your FRA, full retirement age. Key changes. As of January 2025, the Social Security beneficiaries will receive a 2.5% cost of living adjustment. Again, not an inflation adjustment, a cost of living adjustment. The cost of living calculation done by the Social Security Administration is much different than real inflation. The maximum taxable earnings increase, the maximum amount of earnings subject to Social Security's tax increased to $176,100. So if you're working today, you're taxed on the first $176,100 in 2025. This increase of this maximum taxable wage amount means that more income will be subject to tax for workers who are still paying into the system. Other key changes to the Social Security benefits program in 2025 is the maximum Social Security benefit a worker retiring at FRA increased from $3,822 a month to $4,018. That's the maximum benefit you can get if you maximize your PIA. And then that applies for people retiring at their FRA of age 67. And the surviving spousal benefit increased from $1,778 to $1,832. So the max you can get from Social Security is $4,018 a year. And if you're a surviving spouse and you're collecting your survivor's benefit, it's $1,832. Earnings test exempt amounts adjusted. I get asked all the time, how much can I make and still collect my full Social Security? In 2025, that's an individual can make $23,400 per year, $23,400. If you make more than that, your benefit is reduced $1 for every $2 above that you make. So if you make $23,402, your benefit is decreased by $1. In the year the individual reaches their FRA, because most people meet their FRA during the year, you can actually make $62,160 that year. So if you meet your FRA in January, you can make $62,160 that year. If you meet your FRA in December, you can make $62,160 that year and that year only. Above that, it's reduced on a 1 to 3 basis. So for every $3 you make, you get your Social Security is reduced by $1. So if you make $62,163, you're going to get $1 reduced from your Social Security for that year. Withheld benefits are added to the monthly benefit once the individual reaches FRA. Okay. The Social Security Fairness Act repeals the government pension offset and windfall elimination provisions, which reduce benefits 1% for all Social Security beneficiaries and 3% for all beneficiaries, respectively. That means if you worked for the government and you had a pension from the government, you weren't able to collect Social Security before. Now you can collect Social Security. It affects 3 million people who receive pensions from their work as a teacher, firefighter, police officer, or other public service employee. If that affects you, let us know. We'll help you. The One Big Beautiful Bill Act, OBBBA, as of July 23rd, 2025, the 800-page bill introduced under the Trump administration from 2025 to 2028, individuals 65 and older can deduct an additional $6,000 or $12,000 from their income taxes. If you're married, filing jointly, it's $12,000. If you're single, it's $6,000. Qualified individuals and couples may claim this deduction regardless of whether they take their standard deduction or choose to itemize. So talk to your tax accountant, but you got a bigger deduction this year. Deductions phase out for high earners with modified adjusted gross income of $75,000 for single and $150,000 for married. The deduction is eliminated if you make $175,000. You can't use the deduction if you make $175,000 for single filers and $250,000 for adjusted. Probably doesn't really affect your Social Security calculation, but it affects what goes into the Social Security amount. That's why it's in the presentation. All right, so here are some of the key changes. Your standard deduction, if you're single and 65, was $15,750. You get an existing senior deduction of $2,000. You get the OBBBA deduction of $6,000, so your total potential deduction on your income is $23,750. If you're married filing jointly, here are the numbers: $31,500, $32,000, $12,000, $46,700. Okay, so let's talk about the 5 common decision scenarios, because those are the most important parts of this presentation, and I'll try and answer all the questions I get from other people in this video recording. All right, here's a common decision question. Here are 5 of them. Claiming early versus late. What are my spousal benefits? Divorced spousal benefits, surviving spousal benefits, and guardian benefits, specifically caring for special needs or grandchildren. All right, should I claim early or late? All right, so I'm going to read this. Remember that statistic I shared about the average individual losing out on $182,000. Let's not make that mistake. You can collect Social Security as early as age 62, but the benefits can be permanently reduced by about 30%. So if you're at FRA 67, your calculation says you're due $1,000, you claim at age 62, your benefit is reduced 30% a month, 30% for the year, to $700. If you claim it at age 63, your benefits reduce 25, 64, 20, 65, 13. I don't know how they got that number, but it's 876. And if you take it a year early, it's reduced 6.7%, $933. Why would you want to take it early? Well, you need the money. There's no other liquidity. There's no other sources of income. You need it. If you're in poor health, you might as well take it early. If you earn less than the annual earnings cap, you might want to take it early. And if it makes sense for your spouse and your children, these are all planning choices. You can use calculators from us or from the government to help you with these choices, but these are reasons why people typically take Social Security earlier. What are the impacts of taking it later? If your FRA at age 67 is $1,000 a month, and you wait to age 68, you earn 8% more. 69, 16%. 70 is a 24%. It's not compounded earnings. Remember, it's additional earnings. So 8 to 8 is 16, 8 to 24. However, if you wait, your FRA may go up. If you have a lot of earnings, that'll bump your FRA up because you're working. So if you delay and nothing changes, it's an 8%, 16, or 24% change. Taking benefits later also gives you a bigger increase as any COLA adjustments are taking into consideration. Any COLA adjustments are taken into consideration. So if you wait a year and the COLA is 2.5%, it's 8% more of $1,020.50. So it's See how that works? If you wait a year, the COLA kicks in. It's 2.5% on top of the 1,000, and then it's 8% on top of the 2.5% on top of the 1,000. Hopefully I got that across. All right, so if you want to look at this chart, this is important to visually understand it. If you take it early versus waiting to take it at age 70, there's a 77% difference between taking it early for the average person to taking it at the latest age. So there's a big variation. That's a 77% change. So make sure that you sit down with someone who understands this in context of your plan. In context of your plan, because there may be a very valid reason for getting that 8% plus the COLA bump, because you have assets that can be used to bridge those years. For example, if you have a deferred comp plan and you have to deplete that plan over the first 5 years after you retire, many people I've worked with have deferred comp plans that must be depleted. So we deplete those earlier and let the Social Security grow a little bit. Spousal benefits, how do they work? A worker files for retirement benefits. The worker's spouse may be eligible for the benefit based on the worker's earnings. A non-working spouse will receive 50% of their spouse's primary insurance amount benefit when they apply at FRA. But the spouse can take it early at age 62. So their benefit could be reduced by 32.5%. Let's say your spouse is 67, that's the primary PIA number, and you're 62, you can take it when they turn 67, but it's going to be reduced. Spousal benefits are gender neutral. Spousal benefits don't earn delayed credits. So there's no point in delaying it other than you get your PIA, your standard PIA. In most cases, it makes sense for the higher earning spouse to delay benefits up to age 70 to secure the maximum benefit. Of course, if you have lower longevity or higher longevity, you have to look at that. Or if you're sickly and have some diseases that may cause you to terminate early, you have to take that into consideration. But assuming a standard life, this is the rule of thumb. Let's talk about Judy's monthly benefit. Here's a great case study. Judy worked outside the home. Her PIA is $1,000. Jim retires at age 67. His PIA is $2,400. At age 62, Judy decides to claim her benefit early at FRA of 66. She gets a reduced monthly benefit by 25%. So she's going to get $750 a month. Judy's reduced spousal add-on. Judy takes $1,200, 50% of Jim's PIA. You reduce Judy's PIA amount of $1,000. Judy's spousal add-on will be $1,200. $1,200. If she takes her spousal add-on early, it's a 30% reduction. Judy's going to take $140 in reduced spousal add-on. So her total monthly benefit will be $750 plus the $140 reduced spousal benefit. She'll get $890 a month reduced monthly benefit. All right, that's for a married couple. Let's talk about divorced couples. If you're divorced, you can receive a benefit based on your ex-spouse's record, even if they've remarried. If you're 62 years of age or older, you're currently unmarried, your marriage lasted 10 plus years, the benefit you're entitled to is less than the benefit you receive based on your ex-spouse's work. The benefit you're entitled to is less than the benefit you would receive based on your ex-spousal work. Additional items to note: if your ex-spouse is not claiming benefits, you can still receive the benefit if your marriage lasted 10 plus years. If you've been divorced for 2 years or more, and your ex-spouse is at least 62 years old and eligible to file for their own benefit. So if your ex-spouse is 62, you've been divorced 2 or more years, and your marriage lasted more than 10 years, you can claim your benefit. If you're eligible for retirement benefits on your own accord, Social Security will pay that amount first. If the benefit on your ex-spouse's record is higher, you will then get an additional amount so that the contribution of benefits equals the higher amount. So if you want to get the benefit and you earned your own, you'll get your own, then you'll get a supplement to get you up to that number. All right, let's talk about a case study. Gloria's monthly benefit. Gloria and Hank were married for 40 years. They divorced 2 years ago. Hank is 62, his P is $4,000. Gloria was a stay-at-home mom, but she does have a $400 benefit. She's unmarried, not working, decides to claim her benefit at age 62 versus her PIA, her FRA, not her PIA, her FRA of 67. Gloria's early benefit reduction is calculated as follows. She gets $400 on her own, minus the $120, 30% for her own benefit, taking it early. She gets $280. Then she gets the spousal add-on, 50% of Hank's, so she gets $2,000 minus her $400 benefit, right? Not the reduced benefit, the regular benefit. She gets a $1,600 spousal add-on, but the spousal add-on is reduced by 35% because she's taking it early based on his age of $560. So her reduced spousal add-on is $1,040. This is a great chart to snapshot, by the way, if you're divorced. Great chart to snapshot. So her total reduced benefit is the $280 plus the $1,040. Her benefit is going to be $1,320. What about surviving spouses? All right. Surviving spousal benefits. This is super confusing, so I'm just going to read the script here. I apologize in advance. The survivor benefit is based on the high earning spouse's benefits. The survivor benefit is based on the high earning spouse's benefits, including any delayed credits. Even if the spouse is not applied for benefits, the surviving spouse is still entitled to the higher benefit amount. The surviving spouse may claim reduced benefits as early as age 60, or if they're disabled, as early as age 50. In either of these cases, the marriage must have spanned at least 9 months, led up to the spouse's death, must have spanned at least 9 months leading up to the spouse's death. Additionally, the surviving spouse cannot have remarried before the age of 60 or 50 if they're disabled. A survivor at FRA is entitled to 100% of any deceased worker's benefit, including any delayed retirement credits. Therefore, maximizing a retirement benefit also creates the maximum survivor benefit. For ex-spouses, the surviving spouse may be entitled to a survivor benefit of the ex-spouse if they were married 10 or more years. Ex-spouses, not surviving spouses, ex-spouses. If the ex-spouse was born by January 1st, 1954, and has reached FRA, he or she can file a restricted claim for spousal benefits and defer collecting his or her own benefit. A survivor is entitled to 100% of a deceased worker's benefit, including any delayed retirement credits earned by the deceased. That's super complicated. If you need help, we'll have a QR code you can scan to get help from the Social Security Administration, or we can help you. Let's talk about Carrie's survivor benefits. Doug and Carrie are married. Doug unexpectedly passes away. Carrie is age 55. At age 55, meets and marries John, her second husband. At age 60, Carrie went to claim Doug's benefit, but was disallowed because of her marriage to John. She was 55 when she married John, so she doesn't get the benefit. However, she divorces John, She's now able to claim her survivor benefit from Doug. Even though she got remarried, she never was able to claim when she was married to John, so she can go back, get divorced from John, and get Doug's benefit. Guardian benefits, caring for grandchildren. This is very unique. We'll go through it very quickly. Parents of the child must be deceased, disabled, or the grandparent has legally adopted the grandchild. The grandchild must have begun living with the grandparents before the age of 18 and received at least one half of her support from the grandparents the year before the month the grandparents became entitled to receive benefits. The parents of the child must not be making regular contributions to their child's support. The grandparents are already receiving benefits. He, she, or they would need to adopt the child to qualify for additional benefits. So if you're a guardian, you get one set of benefits. If you adopt, you get another set of benefits. Step-grandchildren and adopted grandchildren may also apply. Auxiliary benefits for grandchildren can be as much as 180% of the primary earner's benefits, which would include any potential spousal add-ons. Again, complicated, very small percentage of the population, but if you need help with this, there's going to be a QR code you can scan. Here's a case study. Maria is 68, her FRA is 67, she's unmarried and retired. Her primary insurance amount is $2,000 per month. She's the legal guardian of Anna and Sophia through adoption. Anna and Sophia may qualify to receive up to 75% of Maria's FRA, full retirement benefit, until they're 18 years of age or 19 years of age if they are full-time students still living with Maria. Maria's monthly guardian benefit calculation is as follows. Her $2,000 PIA times 75%, which is $1,500, $750 per grandchild. Maria's new total monthly benefit is the $2,000 plus the $1,500 to get to $3,500. Please note, guardian benefit calculations are based on the level of benefit of the primary earner's FRA Social Security benefit. It is important to consult with the Social Security Administration about this specific situation. All right, this was shocking to me. I almost forgot this, and then I was reminded this when I was preparing for this presentation. How COLAs, cost of living adjustments, affect benefits and taxation. It's interesting. Cost of living adjustment designed to keep up with inflation. My personal opinion, it does not. It's tied to what's called CPIW. The COLA for 2025 was 2.5%. The average monthly benefit increased from 1927 to 1976. If you're concerned that COLAs may not provide you with enough income to combat inflation, consider utilizing other income sources that can provide you with protection of principal or offer some growth opportunities. This is, like I said, shocking to me. It was a good reminder. Taxation of benefits. Social Security benefits are subject to federal income taxes if income rises above certain thresholds. Before the OBBBA, an estimated 50% of Social Security recipients paid taxes on their benefits. Now it's estimated that 88% of recipients won't have to pay taxes on those benefits because the calculation changed. Provisional income. The PI is used to determine whether you pay taxes on your Social Security benefits or not. The PI is used to determine whether or not you pay Social Security benefits. Well, how do we calculate it? Well, here's how you do it. You take your adjusted gross income before Social Security, your AGI, before Social Security, you add back in your muni interest income. That's something that most people forget about. If you have muni bond interest in your portfolio, it gets added back into the calculation and you get what's called the MAD, modified adjusted gross income. Then you add half of Social Security benefit to get your PI. So let's go through that again. You take your adjusted gross income before Social Security, you add in any muni bond income, and then you take half of your Social Security benefit and that gets you your provisional income calculation. Here's a small chart that highlights that. If you're single and you have provisional income of between $25,000 and $34,000 and you're taking Social Security, could be taxed up to 50%. For a single person with provisional income falling between $25,000 and $34,000, up to 50% of his or her Social Security benefit may be taxed. If that individual's provisional income is over $34,000, then 85% of the Social Security benefits are subject to taxation. Married couples, 32 to 44, 50%. Married filing jointly, 44% or higher, 85%. Now, take out your phones, scan this QR code. That'll take you to the irs.gov for an interactive tax assessment calculation to determine if your Social Security benefits will be taxed. Okay? Let's talk about how that works. Here's Jennifer. She's single and plans to continue working until age 70. She would like to start claiming her Social Security benefit at age 66. Her adjusted gross income before Social Security is $50,000. Her adjusted gross income is $50,000. She gets $10,000 in muni bond income, so her modified MAGI, modified adjusted gross income, is $60,000. Then you add 50% of her Social Security benefits. Now her provisional income calculation is $70,000. If over 34, the maximum, 85% of the $20,000 Social Security benefit will be taxed at the 22% tax bracket. That's how the calculation works. So you take that 85% of $20,000 and multiply that by 22%, and that's your taxes. How to handle a mistake. An individual can withdraw their application for benefits only once in your lifetime. And it must be within the first 12 months of your first claiming the benefit. The form that you use is called a Form SSA 521 and repay any benefits they received, including any benefits that a spouse has collected on their earnings record. Then you benefit suspension. There's an option that allows individuals who have reached FRA to voluntarily suspend but not repay the Social Security benefits they've received. It's complicated. We can talk about it individually, but you could suspend your benefits if you want to. Suspending benefits earns an 8% automatic increase every year up to age 70. Strategies to help maximize your benefit. Here are the key takeaways. Most people, 30% of their income, of their needs are met by Social Security. A couple can face up to 9,000 different combinations, and a mistake can cost you up to $182,000 over the course of your life. 88% of people will not pay income on Social Security benefits, but of course you have to do your own calculation. It's preferable to optimize your initial Social Security benefit claim rather than attempting to reverse it or live with a suboptimal. So, before you file your claim, make sure you know what you're doing, or you work with a professional, or you've really gone through the Social Security Administration help desk. To start the process to maximize your Social Security benefits, there are a few questions you must answer. What are my estimated benefits? When do you need to claim them? What are my spousal considerations? What maximum strategies can apply to my situation? If you tend to live longer, you might delay. If you tend to live shorter, you might not delay. To understand the specific benefit and eligibility, go to the SSA.gov. At SSA.gov, you can also apply and get your estimated Social Security statement before you file. So, what do I want you to do? I want you to look at your plan and look at all the sources of income and look at all your needs and wants and make sure you understand how to meet all your needs, knowing that you can grow some of your assets to meet your wants. When you look at your income needs versus your wants, make sure you manage your needs versus your wants differently. using different tools to address those wants and needs. Remember, there are 6 major risks that we need to address when doing your plan: longevity, liquidity, inflation versus COLA, market fluctuations, mortality, early mortality typically affects people more, and taxes. So we appreciate the opportunity to spend some time with you. If you need us, just give us a call. Be happy to set up a free appointment for you. Thank you, and have a wonderful, great day.